This is Nadir Shah in Chicago, and you are watching your channel Knowledge for Quality of Life. Friends, last week I looked at the factor investing model, particularly five-factor investing. Today I'm going to be looking at few valuations markers to gauge the market. Whether it's expensive or it's selling at a cheap discount, or these parameters, these markers I've picked up over the years by reading different textbooks, different data sets, different periodicals. By no means these are the markers to gauge the market or time the market. And I wanted to give you some concepts that, so that people understand that, how things work in reality. There's some kind of a rationale to it. So before I share my screen, I would like to welcome all those who recently joined the channel. And please provide me your comments, concerns, questions regarding the material that I'm sharing here. If you think that, I should periodically switch between the finance and the healthcare and or the education, please put your comments, because I would like you to tell me that what kind of content you are liking or what kind of issues you are dealing with. And if I have dealt with those issues, I have experienced something which I can give my input, I love to do that. So please include your comments, because based on your comments, I'm going to conform my future presentations or material accordingly. So let me share my screen. What you're seeing here is the relationship between sort of a cyclical relationship between US and international market. So the blue curves you are seeing, that is when US stocks are outperforming the international market. So they run in cycles, about 7 to 10 years, or sometimes 5 to 7 years, depending on the situations. And it varies based on geopolitical conditions, earnings, and the valuations of the currencies, exchange rates, and many other factors. So if you see here, the yellow curves, the range where developed international stocks outperforming the US. So for the last almost 10 to 15 years, we've been US markets are outperforming the international. So when these cyclical rotation takes place, if one style is in favor, one market is in favor, it creates the opportunity, or it trades at a discount in the other areas. So for instance, for the last 10 to 15 years, if the US stocks are doing phenomenally well, it means that it's creating opportunity for the international markets. Maybe they are selling at a discount or they are on sale. And we will look at it into the next slide, that it tells you that this overvaluation is directly proportional to somehow the future returns, because and undervaluation is also related to the future expected returns. So I wanted to share this cyclical nature of US versus international, because in the previous vlogs we looked at it, that international stocks in the long run beats the US stocks, particularly international small caps. The style wise, value always beats the growth. So those are the things, we looked at it in the last few vlogs. And today I wanted to share with you the cyclical nature of the markets. So let me share my next slide. What you are seeing in the first top portion of the slide is the cap ratio. Now, you may have heard the price over earnings ratio of a particular stock. When we are talking about the S&P 500, the Fortune 500, it's a conglomerate of 500 companies, and price over earnings ratio. Sometimes it gives you some indication that whether that stock is trading at a discount or trading at a premium. Robert Shiller, a professor and academic person at Yale, came up with this CAP ratio. CAP stands for, it's an acronym, Cyclical Adjusted Price over Earnings Ratio. So basically, it's a 10-year rolling average. 10-year rolling average means it includes, it's moving forward, but in a 10-year form. So every quarter it gets adjusted. As we are done with one quarter, that one quarter gets added, and the last 10 years, the last almost quarter gets deleted. So it's a total 10-year rolling average of a PE. This is a better indicator than just a given value of price over earnings ratio for a given year or forward price over earnings ratio. So it's been tracked since 1871. So if you look at it, it moves in different directions, and it tells you that where we are trading right now. So as of last Friday, yesterday, the price over earnings ratio, and you can track this number on a daily basis. You can see it, because it's live on a Shiller PE. If you Google it, and you will see. I will include the link in the description as well. So right now it's trading at 36.35. It's a small number. It's hard to see, but I can see it 36.35. Now this was close to, if you recall the Y2K bubble bust, it traded as close to 44 point something, close to 45. And it's in the range of pretty high range, and it shows that stocks are sort of reaching its valuations, sort of, so to speak, it's overvalued based on the historic norms. And if you look at the bottom graph, it shows that how the CAP ratio is related with this relationship of future 10 to 15 years return. So if you read this thing, it's very hard to read, small, but it's the given year of CAP ratio. It tells you that what will be the following 15-year return on those stocks. So they have taken all the market indices from variety of U.S. and international markets, and they plotted. So if you look at red color, that's Japan, yellow is Germany, and USA is dark blue. And this is this light blue is all equity markets combined. So if you look at this on the x-axis, it's a CAP ratio, cyclically adjusted price over earnings ratio, which is this one, right? This is for only S&P 500, but you can find out, on the websites, any CAP ratio of any particular country or region. And that's not a big deal. It's readily available on the internet. Now, if you look at this number, this x-axis is CAP ratio, and y-axis shows you expected return. So the lower the CAP ratio, higher the returns are. That's how it goes. So it means that right now, if you look at S&P 500, 36.35, so it's going to fall somewhere in where my cursor is. So the expected return is going to be almost very small, because why? Because the stocks are trading at a historical high P ratio, CAP ratio, and this correlation is expressed in this kind of equation here. So point I'm trying to make here that what the future returns, what the last 10 years return, you may have looked at it, it doesn't mean that you're going to get the same return in the next 10 years, because returns is directly correlated with the cyclical adjusted price over earnings ratio, how it's been valued over time, and what was the entry point. So if somebody buys the market At this point, at 36.35, the expected return in the next 15 years is going to be a low, very low. This is what the curve says, and it's a long history of data, so it's very reliable. Now, this one, I picked it up over the years, this cap ratio. So what it tells me that if the cap ratio is between the range of 0 to 5, it's a generational lows, means it's trading at a deep discount, deep, at a sell value, it's stocks are on sale. Because if you look at the previous curve here, the cap ratio, it's almost 5 years. When it happened? During the Great Depression time. Okay? This thing happened in 81, 82, when the inflation took off, and during the Carter administration. If you read the history of the economy during the various administration, what happened. And then it created another opportunity in 2008 and 9 when we had the financial debacle. So we are getting close to here at the high value. So if the P or cap ratio is between 0 to 5, it means that it's extremely buying opportunity. Of course, you need to have a strong stomach to step in and buy at that time. And then cheap is 5 to 10, anywhere from 5 to 15. Cap ratio defines as a cheap as well. But as soon as you get in the range of 20 to 28.8, it's a caution zone, yellow zone, means it's getting to the full value. And if it's in the red zone, which is 28.8 or above, then it's getting towards bubble. So right now, we are in that kind of a situation. I'm not predicting any huge downturn, but for myself, I'm being very cautious. This thing tells me that if market is overvalued or undervalued, or it's trading at a fair value. On the same side, if you look at this is I'm talking about cap ratio of large cap stocks. Okay, but on the contrary, the small caps are telling totally different story. So this is a price over book ratio. So price over book ratio is another value of the marker, which tells us that if the price market value of the price is 1.0 and book value of a particular company's market cap based on the asset value valuations, if the book value is less than 1, it means that the ratio is trading at a P over B ratio is less than 1. It means that it's trading at a little discount, or on the contrary, on the same side, if you look at that, if it's trading greater than 1, it means it's trading at a premium. So if, let's say, S&P 500 has a book value of 1, it means that the price of the market and the combined book value of the S&P 500 companies is trading at, also it's a 1. So ratio would be 1. But if the PB ratio becomes 0.8, let's say, then it means that it's trading at a discount of by 20%. Okay, so this is a 15-year minimum of PB ratio of US small caps. Okay, so that's 1.75. This is a 15-year average, 2.73. This is the 15-year max, 3.26. This is for the US stocks, small cap value. This is this is for the international small cap, and this is for the emerging markets. So this cheat sheet I have created from reading the various data sets and all those things, and I created that this is the buying opportunity between this range, because remember that there is no exact low point or high point anybody can predict, or you cannot time the market. So if you get in at a certain point at a discount, it means that the chances are in the next 5 to 10 years to enhance your return. That's all I'm saying. because you know that your entry point was low, okay? And what are the selling points are? If the PB ratio gets to the range of 3 to 3.5, it means for the US small caps, it means that you are getting to the close to the top, not necessarily the top, but getting close to the overvalue situation. And international small caps, same at 3 to 3.5, and in emerging markets, 3 to 3.5. So let me stop share here. So these are the few tools I gathered. If you look at it right now, the US small caps are trading at a discount as compared to the S&P 500. Now, within the S&P 500, the cap ratio or the returns of the S&P 500, it's driven by Magnificent Seven, which you may be hearing in the news a lot. Those 7 mega cap technology stocks. But if you look at the overall return of the S&P 500 companies, it's not that great. The way it's for the Magnificent Seven, because it's weighted and it pulls towards the higher end. So if you look at in comparison with the small cap value is providing you a bargain right now. They are out of favor, they are not in favor, but anything happens to the overall market because of the geopolitical conditions we are in, anything would trigger the selling of the market, or anything would take the market for the correction in the next near future. Of course, it's going to impede a little bit on the small cap value as well, and international small cap value and emerging market as well, because we are living in a so connected world. But the chances are of those small caps and emerging market or small cap value US, which are already trading at a discount, is low. They're not going to get corrected too much, because they are trading at a discount already, because a lot of froth has been already taken out. But the correction is going to take place, most of the correction, which is trading at a lot of premium, a lot of higher valuations, which we are seeing in the cap ratio of S&P 500 as 36.35. Because if you recall that what happened in 2008 and 9, average stocks had a correction of 50%, close to 50%, and small caps lost about average 56%. So and same with the emerging market, because we are living in a global connected world. So one market impacts the another. So just be mindful of that when you are picking something, either it's your IRA or 401k, don't look at the past return of 5 years or 10 years, because that may not give you an indication of your 5 or 10 years future returns. Because if the last 10 years or 5 years returns are higher, and based on the cap valuations, the chances are from that curve relationship, the next 5 to 10 years are going to be lower returns. So I hope that you learned something from it, and if you have any questions or concerns or comments, please share in the comment box, and I'll try to address accordingly. See you next week. Bye.